Did you know that back in 2021, the median income per household in the US stood at $70,784, and of course the median wage hovered around $45,760. An interesting question often asked, and rightfully so, is what kind of house can I afford with my average income? Many people frequently ask, given my income, what kind of house can I afford? Or how much can I qualify for? But first and foremost, I must clarify that this is highly subjective to the state that you live in and your personal finances. For instance, in the Midwest, with a budget of about $2,000 per month, you could snag yourself a very nice home. But tread carefully if you're in California, because the same amount might just score yourself a fairly roomy, well-ventilated cardboard box. So a lot depends on your state and personal circumstances. Today I'd like to explore how much house you can afford with the average median income in the United States. It's really important to debunk some widespread misconceptions about what factors influence the kind of house or monthly payment one qualifies for. Contrary to popular belief, your credit score does not directly impact the value of the house that you can afford. High credit score does not translate into a more significant purchasing power. It does, however, grant you access to more diverse options and better interest rates, which in turn can lower your monthly payment. But while a higher credit score doesn't necessarily mean you'll qualify for a higher loan amount, it can help you manage your monthly payments better. The key determinant here is your debt to income ratio, or your DTI. The formula that I'm going to talk about here in a second will help you understand where you stand. Understand your standing. Understand your standing. The formula calculates your minimum monthly payments on your credit. It then adds them to the monthly payment you qualify for and divides the sum by your gross monthly income. The result cannot exceed the max ratio of your loan program. Now, to find out your qualifying monthly payment, you can follow a simple set of instructions. So let's begin. We're going to start off by clicking the like button. Next, let's find your minimum monthly payments. This should include all your minimum payments that you're making against your credit. We aren't considering things like your power bill, your cell phone bill, or any of the under-the-table payments you might be making. We take this number and then we add it to X, which in this case represents the unknown monthly payment that you qualify for. And after this, we divide the sum by your gross monthly income. This is simple if you're a W-2 salary or hourly wage earner with 2 years of employment. Just take the gross income from your last few paychecks and you're all set. The gross income is the total income before any deductions. For self-employed individuals, it's a little bit more complicated because they're going to take your net income from the past 2 years. If you've been writing off a lot of your income, it might adversely affect your qualification. The average net income of the last 2 years is divided by 12 to get your qualifying monthly income. Next, we consider the max DTI ratio allowed by the loan program that you're using. For conventional loans, it's 0.5, and for FHA, it's 0.56. But remember, you should not aim to buy a house that puts you at your maximum ratio. It's best to have some wiggle room, and you don't want to stretch your finances too thin. Once all the numbers are plugged into the formula, we solve for X, which in this instance is the monthly payment you qualify for. For this, we use your gross monthly income, multiply it by the max ratio for your loan program, and subtract your total minimum monthly payments. Let's use the US median wage of $45,760. We should begin by figuring out how much monthly debt we need to pay. For instance, let's say you have 2 credit cards with a minimum monthly payment of $35 each and a car payment of $300. This brings your total minimum monthly payment to $370. As a side note here, don't just pay your minimum on your credit cards. Get them as close to paid in full each month as you can. And also, try to get the cards that reward you for using them. There's a lot to unpack in that subject all by itself, but play the game and play it smartly. I digress. But dividing the median annual wage by 12 gives us a gross monthly income of $3,813. Using a conventional loan max ratio of 0.5, we can plug all these numbers into the formula and solve for X. Remember, the goal is to calculate your maximum allowable monthly payment, not to exhaust it. But let's get started. Let's substitute the known variables into the equation that we have. The gross monthly income of $3,813 and the maximum ratio for the conventional loan is 0.5. So 3813 multiplied by 0.5 equals $1,906.5. This is the maximum monthly payment that our hypothetical person with the average income can afford according to the lender's terms. Now, subtract the total monthly payments and debts from this number, which was 370. So 1906.5 minus 370 equals $1,536.50. The result is the maximum monthly mortgage payment that the individual could potentially qualify for, existing debts, and the terms of the conventional loan program. Of course, this is just the theoretical maximum. As I mentioned earlier, it's best to aim for a payment that is comfortably below this amount in order to maintain a reasonable standard of living and have a safety net for unexpected expenses. You should all strive to have 3 to 6 months of savings stashed somewhere. Many banks are also realizing that they need to compete with others that offer higher interest rates on savings accounts. No longer do you get 0.0000002% interest for storing your money with that bank. Now you can find some savings accounts that can pay you as high as 4 or even 5% interest just for putting your money there. Now we have one more step. We know the maximum monthly payment this individual can afford, but we're originally wanting to know what kind of house the average income can afford. To convert this monthly payment into a house price, we'd need to consider several factors, including interest rates, the length of the mortgage, property taxes, and insurance costs. For example, with a 30-year mortgage and an interest rate of around 7%, which is about what the rates are currently at the time of recording, $1,536.5 per month would roughly equate to a loan of around $200,000, assuming property taxes and insurance costs of around $300 per month. However, these figures can vary widely depending on local property tax rates and insurance costs. One really good place to check is the mortgage calculator on bankrate.com. You can go there and play around with the numbers yourself, and it's a really good resource when shopping for a new home. And I would also like my Bankrate sponsorship any day now. So in conclusion, an individual with the average income in 2021 could potentially afford a house costing around $200,000, assuming they have typical debts, are eligible for a conventional loan, and are willing to use the maximum allowable portion of their income for housing. But again, it's crucial to remember that these are rough estimates, and the true figure could be higher or even lower depending on many factors. Always consult with a financial advisor, or you can consult with a trusted lender before making any major financial decisions. Also, a realtor can help you find the right people that have shown to be trustful in their businesses. If you need help, I have a network of realtors across the globe that can assist you. If you're in Chicagoland, don't hesitate to reach out to me and talk about your plans. But that's going to do it for this video. Please subscribe to my channel and hit the like button if you found this helpful. And I will see you in the next video.